Hello and welcome to NDTV Profit. Now, with the latest fundraise announcement by Federal Bank, one thing is clear. Foreign buyers are finding their way to Indian banks. This is now the fourth bank which has confirmed that a foreign investor is buying a sizable stake. This is also the sixth such deal where an Indian financial services firm is raising equity from investors abroad. We have had the likes of IDFC First, Yes Bank and RBL who have made similar announcements. Other than them, non-banks such as Manappuram Finance and Samman Capital have also joined the party. The questions then to ask our guests is what is actually bringing this investment in? Why Indian banks now? And lastly, is there going to be some amount of regulatory change in strategic thinking? And to discuss this and further, I have with me my guest for the day. Firstly, let's start with Gurmeet Chadha from Complete Circle. Gurmeet, welcome to this conversation. I want to start off that conversation, that first question with you. We also have Vivek Ramji from Grant Thornton Bharat, who's joining us in this conversation. I'll start with Gurmeet first, though. What is happening with Indian banks and Indian financial services firm? Why is there so much foreign investor interest coming into this?
So, if you see, there have been a few changes RBI done. It started with the liquidity approach changing last year with CRR cuts and then, liquidity measures. Then I think there's been a regulatory shift in last two credit policies. In fact, the last policy was more like a credit policy where they changed the lending norms from a rule-based approach. It's now becoming more flexible, market-driven approach. They reduced, even in small finance bank, the priority sector targets were kept. The risk weights were reduced to infrastructure lenders. Host of measures. There were 22 measures, a kind of a mini budget, if you may call it, from a banking parlance last policy. And I think third is openness to, get more foreign capital, especially in banks where either there has been a stress in the balance sheet or they need growth capital. So I think it's an important pivot from a liquidity point of view, regulatory point of view, credit point of view, and a growth point of view. As economy growth picks up, as consumption picks up, I think RBI also wants to lesser micromanage, banks and have more stronger entities. And that's an important shift. So I think you will see more in the offering. There could be more revision to the voting right issue, which has been pending for long. There could be also increase in limit to individual investors, which is automatic route is 5%. And with RBI approval is around 9.9. This may also be relooked at. So you will see, I think this is banking reforms 2.0 loading in my view, and with openness to get good marquee names, and some of the names which have come in, which is in Yes Bank, in RBL, and now with Blackstone. I think these are very marquee names. So sends a very strong message to from an FDI perspective also.
Banking reforms 2.0 and a strong message to investors abroad, across the board. Vivek, I want to take this question with you. I understand from a domestic point of view why the system seems to be opening up. But from a foreign investor point of view, if you can tell us a little bit about what Indian banks are giving them as potential investment opportunities.
See, from an investment standpoint, obviously there is a significant demographic dividend in India. With the whole focus on increasing financial inclusion, the market size that is actually available for all banks only increases. As a result of that, the growth opportunities that is actually available for each one of the financial institutions is significant. Given this fact, it obviously offers a great investment opportunity. Secondly, it also offers a good diversification for them compared to how the rest of the world is doing. There is significant uncertainty in the rest of the world, and investment in an Indian banking system is an exposure to the Indian economy. And as a result of that, they are able to kind of make returns from the domestic growth story. So from a foreign investor standpoint, demographic dividend and the opportunity to participate in the Indian growth story. I think these are the two significant opportunities that gets foreign investors significantly interested in India.
Gurmeet, the pricing of these investments has also been quite a bit of discussion point. You saw 272 on RBL Bank. Today's is 227, slight difference in the numbers, but interesting sort of figure because it's coming very close to where the current trade is happening on that stock. So I want to understand from you, how do you see the pricing of these issues? Do you think that they're coming at the right valuation, or is this being purposefully underpriced because a lot of this is also primary money that's coming into these banks?
See, for example, Federal Bank still trades at about 1.1, 1.2 book value. It doesn't necessarily need capital the way probably RBL did because of the stress in credit card and microfinance and some of the other portfolios. This probably would be growth capital, actually improves capital adequacy and most norms by a few basis points. So it's essentially growth capital. I think the earlier focus was more, if you see the previous deals, to bail out troubled banks. So if you see DBS over Dhanlakshmi Bank and some of the other deals, it was more in terms of getting a bailout. This seems to be more a bit of growth capital and a bit of much needed infusion, especially Federal Bank. And Federal Bank also had a leadership transition, Mr. Manian coming in from Kotak. A lot of respect for him in building Kotak the way that franchise is today. And last quarter results were pretty good. Their CASA improved, their NIMs improved despite repo rate cuts and a challenging environment. The loan mix seems to be improving. So it's on a good path. So some of these banks are around price to book. And with this kind of capital infusion and more importantly, good names coming, opens up more avenues. For example, cost of fund issue gets more broader. You may have lower cost of funds, broader access to foreign capital. With RBI changes in investment banking, they have allowed acquisition, for example, to be financed through bank. To me, that's a big move. And if larger players come in, that's a big positive. Also, the cap on lending to corporate, which was capped at 10,000 crore, above 10,000 crore, you had to provision 3% more, which made it very unviable. That goes away. So multiple things will happen: growth capital, acquisition related funding, corporate loan book. And last 4 or 5 years, if you see it, it's been the retail book which has been surging, in corporate book, and the mid corporate book has not been going that great. I think that could change now with a lot of host of these development, and as you know, the private capex cycle picks up.
I'm curious to understand your view, Gurmeet, on the domestic investors, how they should view these opportunities that are opening up, right? Because these foreign investors, lenders, whoever is showing interest in the domestic banks, so should your local investors also start looking at them as re-rating opportunities?
Looks like selectively in few banks, and especially with exit of Citi in the past, where assets were sold to Axis Bank, few other foreign banks exited. I think also a good message also goes to international investors. I think banking will see a bit of a re-rating, especially in banks which are more favorable in terms of price to book valuations, whether it is Federal or RBL. Even Yes Bank, I think, is going a lot of. There will be a more transition. I think there will be more cleaning up, which needs to be done in the balance sheet. But it's a transition going on. So some opportunities will come, and government has made this fact clear that they want a couple of our banks in the global league in terms of the sheer size of the balance sheet. Today, SBI, if you see, is about 55 lakh crore, which is not even $1 trillion balance sheet. It's got 600 odd billion dollars. So I think you will have 2, 3 large banks also figuring in the global league. So I think from a long-term view, looks good. Credit growth is picking up, GDP growth is picking up, and banking is great proxy, as you rightly said, to nominal GDP growth.
I want to take that point forward from Gurmeet. So Vivek, I'll come to you. What is it that your smaller banks or their mid-sized banks are offering that your larger peers, because the large part of this investment is coming into the mid-sized banking space, right? Like IDFC First, RBL, Yes Bank, now Federal Bank. What is it that they are giving that your larger peers are not giving at this stage?
No, I think they don't need capital. I mean, there is no there's no dearth of opportunities there, and in some cases the foreign limit is also almost to the point it is allowed. Smaller banks give you scale because the base is lower. Valuation, as I said, whether it is Federal, whether it is Yes, whether it is RBL, it's more closer to book value. HDFC, ICICI trade at 3 to 4 times book value. So there is valuation, there is scale, and more importantly, RBI would be more keen to have stronger hands in rather, I would not say weaker, but less stronger bank than the top banks. It's a combination of both.
I was actually asking this question to Vivek also because, Vivek, when we are looking at the current lay of the land in the Indian banking sector, what is it that your mid-sized banks are giving that your larger peers are not giving you as an investment opportunity?
See, as an investment opportunity, the mid-sized banks offer a lot more upside compared to the larger banks. The reason, obviously, is because of the fact that they are far more nimble in terms of new products. Their ability to kind of get into partnerships and alliances is far more flexible. And their ability to also kind of work back on their technology stacks, which serves as a backbone for supporting any kind of growth from their standpoint, is easier compared to the larger banks. So their internal structure enables them to be nimble and quick. And as well as, given their current level of scale, there is a lot more upside in terms of the returns that can be generated as a result of adding more scale. So from a mid-sized bank standpoint, there is a lot more opportunity in terms of capital from that standpoint, which is where you see investments essentially in terms of there, because the need for growth capital needs to come from an opportunity to be seen for growth, and greater opportunities for growth is for the mid-sized banks with an ability to generate more returns. So that's at least where I see that segment offering a greater return on investment compared to the larger organizations.
Super. On that point, I have with me Ashwin Parekh, of course, a long-term banking sector watcher, an expert in everything. Somebody I go to whenever there is a question on situations like this. But Mr. Parekh, the first question to you: when you see these investment announcements that are coming in, and they're coming in fast and furious, right? How do you view the sector? How do you view these announcements in the context of the business that is happening today?
Sure. So, see, one thing is pretty certain, that banking in India or worldwide, I mean, it's a very long-term business, and sort of normally it does return quite well if you're very particular about the quality of your book, basically. So, I mean, certainly it's a good attraction. Now, what is important, however, is, I mean, the opportunity is always there. What is important is that the regulator has really agreed to really bring in both financial investors and strategic investors. We saw, in case of, let's say, RBL, for example, we have a strategic investor who's coming in. So in both the cases, I see that the stories are very different. In case of financial investors, of course, they will not be able to take more than, or they won't take more than 9.9% or 10% of the equity, and that too, they have to go through the RBI approval. Everybody has to go through the RBI approval. But only in case of strategic investments, the desire on the part of the capital provider would be that they would want to give a shape to that organization, to that bank, and therefore there would be larger participation in governance, in day-to-day management as well, in fact, through the governance policies. So to that extent, I would say the investments that we are seeing now in the banking are very different. But banking certainly is a very interesting sector for foreign investors, both financial investors and strategic investors, to look at.
Understood. Gurmeet, I want to come back to you. When you are looking at, when you're looking at the spate of announcements that are coming in, and as somebody who actively participates in the market out there, do you think that there is a valuation premium now, maybe for your mid-sized banks, because you've got honestly, they've got the bragging rights, right?
No, I think you have to be more balanced because banking is far more complex. You also want to have banks in a portfolio where you don't wake up in the morning with any credit accidents, and you need stability. So it's like having larger banks which give you stability, returns in line with the broader credit growth. I think credit growth you will see now getting into early double digits and probably more as couple of quarters go by. So you need that, and I think if you see HDFC's commentary after 2-3 years of consolidation. And mind you, it is a 27 lakh crore balance sheet. To say that now we will grow faster than industry also means that you probably will be adding, let's say, a Kotak Bank or an industry bank every year, right? So you need stronger banks because they've consolidated, whether it is ICICI, HDFC or SBI. And then you need some of these banks which can give you high growth with some bit of volatility because, as I said, in some banks like RBL, Yes Bank, there is still work in progress in terms of skeletons getting cleaned up, in terms of provisioning, etc. So I think a combination should help, and you should be a better risk manager also, especially in banking, because when it hits you hard, you don't know what has happened in banking, right? So be more balanced, and once banks who manage risk better eventually give returns better.
It's an interesting point you're bringing in, and I want to ask all three of you one by one. So I'll start first with Gurmeet. When you are in this situation, Gurmeet, where the conversation is about these foreign investors coming in, there's also this noise about, we are giving up too much to a foreign investor because these are, at the end of the day, banks in India who are going to serve Indians, right? We shouldn't be letting so much foreign interest come into the bank. How do you view that?
See, I think, as I said, you'll see more reforms. My sense is that cap on corporate investor will also be relooked at over a period of time. RBI will be selective with it, considering some of the bad experience you've had in intergroup lending and intragroup lending in the past, without taking names right now. So I think, but as I said, they will relook at. I think that even the voting rights should be looked at some point of time, and even the cap, which is 5% currently on automatic route, and around 10% to RBI will eventually also be looked at selectively. So I don't think so there should be any complaint as far as that is concerned. And look at some of the corporates wherever there are opportunities. We have seen investments. So, for example, in RBL, you have an M&M which had 3.3% stake. It can obviously would have gone up. You have, let's say, for example, Zerodha having stake in RBL. So a lot of corporates also are showing interest, other than the fact that they have their own NBFCs in picking up and being passive investors. So there will be two kinds of corporate investors: one being passive and one who really want to get a proper banking arm in place. So I think more things will come up. You will also see more reforms and more flexibility as far as even the smaller finance banks are concerned.
Sure. Vivek, quick question to you. Okay, when I was talking to the CEOs, the past CEO at Federal Bank, Shyam Srinivasan, and the current CEO, K.V.S. Manian, and I know I'm not asking you a question about Federal Bank, but the direction in which this is going, right? So, one of the core tenets of Shyam Srinivasan was to have the most admired bank out there. I think every bank will probably want to chase some variation of that, right? With the new CEO, it's more focused on growth, on delivering better returns to shareholders, while also being fair to the customer. With the inclusion of a private equity investor or somebody who's considered not very strategic, but considered more short-term return-oriented, do you think that domestic banks face the problem of profitability over service?
So it is a consistent dialogue that actually happens within the private equity as well as the banking institutions. Banking institutions tend to view the whole decision over a long term and actually see it as a continuum. So sometimes it is about also explaining to the private equity investors that that the kind of profitability expectations that you may have in the short term, you will need to kind of temper and understand that, because over a long term you need to look at your investment. So it is a consistent dialogue. I'm not saying it's an easy conversation. I'm not also saying that, oh, private equity will definitely have a long-term focus. No, the focus is on returns. The whole idea is to facilitate actually a dialogue between the banking institution and the private equity, primarily from a perspective of ensuring that both are aligned, which is also one of the reasons I believe that it is not probably the right time to increase voting rights. Because I believe that it is also very important for an Indian institution to run the banking institution in the context of the country within which it operating, which necessarily may not be something that the private equities may be able to kind of understand immediately. Because you need to be a hands-on operations manager to run a business more effectively. That's at least where the piece is, but it actually requires a consistent dialogue. And I believe that having with the investment coming in, it essentially means that the stakeholders are aligned. There are conversations, because essentially a deal would conclude only when I think both the parties are on the same page with respect to how to look at growth.
Of course, of course. Mr. Parekh, a question to you about regulatory easing as well. There has been commentary from Gurmeet about the fact that we are going towards an easier regulatory regime, maybe less strict on entry barriers, but still ensuring that your supervision and regulation remains tight. When Vivek was talking about the voting rights cap, that is also a very contentious issue, that 26% should that continue or not. How do you view the regulatory landscape evolving? And do you think that maybe easing up on these things is essential in the current ecosystem?
Yes, I mean, it is. So, I mean, let me at the outset say that banking is certainly a medium to a long-term kind of a proposition. I mean, it's not one of those where, let's say, you're looking at a 3-year or a 5-year horizon. It will have to be a little beyond that. I mean, if you're looking at 5 years, then you will have to really tame your expectations. I mean, as Vivek said. But I would just put it in a different perspective. See, if I look at insurance sector, for example, and I'm only drawing some comparison, only a little one. I mean, insurance is a long-term kind of an investment, kind of let's say, a requirement or an environment. Now, there I find that of late, the regulator has been going very easy or very slow in approving, let's say, financial investors, particularly coming from PEs. I mean, private equities and all, they've been very particular about it. Now, I thought, I mean, one of the reasons why they were doing that was they wanted to understand investors behind that specific fund from which, let's say, this particular investment is likely to come in, and whether they will stay put for a longer period, and if there is a need for further capital requirement in the bank, whether the investors behind would be prepared to do a second round of funding or a third round of funding. Now, these are some of the complicated questions, basically. The regulator will have to be mindful of this, certainly, because we may have a situation like we had, for example, during the global financial crisis, when we started realizing that people were pulling out their investments from out of India, they were taking them back home, for example. So if you have too much of this without adequate sort of guardrails, then this could lead to a bit of a question mark later on. I mean, the hot money, as we call it, may start getting away from the banking system after a certain period. So it has to be a bit of mix of both, strategic and financial investment, both, keeping some kind of a medium to long-term sort of requirement in mind. But yes, the regulator is warming up, and this is very encouraging to see. There is a recognition that banking sector needs much more capital, and it cannot come only from the retail investors any longer. So therefore, and then it's not going to come from businesses or corporates. I mean, the RBI has clearly said no to it. So in that backdrop, I thought, raising capital from, let's say, foreign investors, both financial investors and strategic, is a good way out for the regulator to look at. I mean, but of course, they'll have to start putting some good guardrails, and as well as at the same time open up a few things like voting rights and all at the same time. So it's a bit of both. I mean, basically, a dilemma for the regulator.
Sure. Gurmeet, you've mentioned a couple of times about the easing regulations. You've also talked about corporates in the space. I think one complaint that a lot of people seem to have is that the minute you open the financial services or actually banking space for corporates, a lot of business ends up being serving the broader corporate entity rather than the customer. How do you view that argument?
I agree, and I think there has been, as I said, instances in the past, especially when NPS ballooned from 2009 to 13. Different names were called. So I think, as I said, RBI will be selective. You cannot have a blanket approval of corporate investing and limits going up. I think selectively, but well-run corporates, well-governed corporates, a good track record, I think need to be given a pie along with foreign investors in the Indian banking space. And I think RBI will selectively look at it. And as I said, we would see more reforms coming in. So I think it will be a very balanced approach, and that's why you see they are doing it, on a step-by-step basis. The first important thing was liquidity. Second was in terms of leniency in credit, because RBI became too tight when post 2019, and in terms of micromanaging it, in terms of getting into even something like KYC norms and digital banking norms being flouted, etc. I think now, once the message is sent, they're gradually opening up. And as I said, you will see series of steps. So this is just one step in terms of corporates being allowed. More will follow.
Got that, Gurmeet. Last question, and we're really running out of time, gentlemen, but I want to ask first Vivek and then Mr. Parekh. The situation seems to be buy rather than build, especially when your foreign investors and foreign banks are being concerned in the current landscape. How do you view this, Vivek? Firstly, you.
So it makes sense to basically get into the buy and to the buy versus the build approach, because see, banking, India is a unique market, and banking in the context of the Indian market is not something that essentially a foreign investor would be able to understand immediately from the word go. And also the regulatory environment is continuously evolving. There needs to be a lot of experience in terms of understanding the market. So the best way to approach would be to take the buy approach instead of build, because build essentially would require a far longer waiting period.
Mr. Parekh, a quick answer from you on this as well.
Well, actually, it's a very interesting subject. What happens in the normal course is that in case of build and buy, for example, build or buy, I mean, we've seen that, let's say, if you look at foreign banks or banking presence in India in the 90s, in 80s, 90s, and 2000, it was fairly strong. I mean, they were actually dominating the market in terms of good technology, good risk management practices. 2000 onwards, things changed. And then after global financial crisis, things changed dramatically. Foreign banks started losing their interest in India. Many of them wound up their even branch presence in India. Once again, the interest has begun because India is a very performing economy. And I suppose people have started once again looking at India, I mean, and banking in India as an opportunity. But I still believe that from the regulator's perspective, he'll have to exercise a lot of caution. I mean, in terms of inviting this capital into the banking system, they have to make sure that at least it stays in the system. I mean, because one of the prime factors is credit expansion.
Yeah.
For which you need capital. And just cannot, I mean, the CD ratios are already hitting the roof at the moment at this point in time, which means more and more capital is required by banking system. With disintermediation arising out of less deposits going to the banking system, I think capital is the only answer. And that's something the regulator seems to have recognized that.
Understood. All right, Mr. Parekh, Gurmeet, as well as Vivek, thank you so much for joining us on this conversation, gentlemen. It's been a pleasure talking to you as always. I wish we had a little bit more time to have to delve a little bit deeper into this. But that was our conversation. Stay tuned to NDTV Profit for more news and updates.